Intel beats expectations by a massive 12%, sending its stock surging, while at the very same time, the Dow plummets by over 500 points. How can a market pull in such violently opposite directions in a single day? Hello everyone, welcome back to AI Market News. Based on available data this morning, we are seeing a significant policy shift that impacts all of us. The U.S. Trade Representative has implemented new, permanent Section 301 tariffs targeting 60 regions worldwide. For Japanese investors in particular, this is an absolutely crucial development, as Japan's tariff rate officially increases from 10% to 12.5%. So let's look at the underlying mechanism driving the market's reaction. When these new tariffs take effect, they immediately raise the cost of imported goods entering the U.S. This cost increase feeds directly into domestic inflation expectations, which ultimately makes it much harder for the Fed to justify cutting interest rates anytime soon.
Amidst that macroeconomic policy shift, let's pivot to a major corporate bright spot. Intel delivered a genuinely impressive quarter, reporting a massive Q2 earnings beat, with revenues hitting $16.1 billion. This marks a significant 25% year-over-year increase, which is a rare feat in the current, highly competitive hardware climate. It proves that the turnaround strategy under CEO Lip-Bu is gaining serious traction.
The crucial point here is understanding the why behind this success. Intel's 12% stock surge wasn't just driven by AI hype. Instead, it was fueled by broad-based strength in traditional PC and server chips. This clearly signals to all of us that enterprise spending remains highly resilient, even in a turbulent macroeconomic environment. However, that localized corporate strength did not save the broader indices. As you can see in the chart, Intel's individual success sharply contrasts with the broader market's immediate downward reaction. We saw notable declines across the board today. The S&P 500 fell over 1%, the NASDAQ dropped nearly 1.5%, and the Dow took a steep 507-point hit. So what exactly drove this broad selling pressure? According to current market information, it's a combination of mounting forces negatively impacting sentiment. We are seeing elevated tensions in the Middle East, with Trump issuing new warnings to Iran. This geopolitical stress keeps oil prices hovering near $90 a barrel. Add in some lingering tech sector skepticism following Alphabet's recent earnings, and we get a perfect recipe for a defensive sell-off. This mood shift among traders is quite clear. The graph shows the VIX, our primary fear index, edging up to 18.86. The underlying mechanism here is very interesting because it doesn't indicate outright panic selling. Instead, this elevated level tells us that institutional investors are cautiously repositioning their portfolios into defensive sectors rather than blindly dumping assets. Let's move over to the Japanese markets to see how this plays out globally. The Nikkei, faced its own headwinds today, pulling back in tandem with global markets. This price action occurred alongside the release of Japan's June National Core Consumer Price Index, which came in at a relatively muted 1.6% this morning, JST. For Japanese investors navigating this space, here is the exact mechanism at play. A CPI print that remains steadily below the Bank of Japan's 2% target signals that there is no urgent pressure for the central bank to hike interest rates in the near term. Because rates stay low in Japan, the wide yield gap between Japanese and U.S. government bonds is firmly maintained. As you can see in the chart on the left, U.S. 10-year Treasury yields remain quite elevated at 4.687%, driven heavily by those tariff-related inflation fears we just discussed. Because the Bank of Japan, is holding rates steady while U.S. yields stay high, this dynamic directly weakens the yen. That actively pushes the USDJPY exchange rate higher, as shown on the right. Before we close, we need to briefly look ahead to our economic calendar, as the coming days are critical. Next week, on July 28th and 29th ET, we have arguably the most consequential FOMC meeting of the year. The key focus for all of us will be how Chair Warsh addresses the inflation outlook in light of these new tariffs and persistently high oil prices. This meeting will likely set the tone for all of our portfolios through the rest of the summer. The ultimate question for us now is, will this be the catalyst for a late summer rally or the beginning of a much deeper correction? Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.